Welcome back, members. CA Kinjal Sai introduced us to the GIFT City and AIF, and CSAS has taken us to the journey of setting up of AIs and compliances and execution of AIF and administration part of it. Now we have with us CA Jugal Kajaria. He will guide us to the income tax part of it, mainly taxation part of AIF and investors taxation part. We welcome you, Jugal sir. May I request CA Bijal Doshi to make a formal introduction of Jugal bhai.
Thank you, Manish sir. So, Jugal sir is partner at EY India's Tax and Regulatory Practice. He's qualified chartered accountant as well as company secretary with over experience of 17 years and specialized in financial service sector. He has advised a number of FS clients in identifying the structures with regard to inbound and outbound investment involving in IFSC based on the GIFT City. He works closely with IFSCA and GIFT City authorities on various GIFT City related developments from a regulatory and tax perspective, and has been involved in a number of tax and regulatory representation involving in GIFT City. With this brief introduction, I'll request past convener CA Manish Sheth to please present memento on behalf of BCSE. I request committee members chairs to please present the contribution towards CABF fund. I request Jugal sir to please start with his presentation. Thank you.
Hello. Thank you. Good afternoon and very warm welcome. Thank you. So I got the opportunity of hearing the previous two speakers, and between Kinjal Bhai and Shreyash Bhai, I think everything is covered. I don't have much to cover. But as we were going through the presentation, I just realized that there were some nuances on the GIFT City that I would like to cover as a part of the presentation. My focus is going to be largely around the GIFT City ecosystem and how new models are coming up in GIFT City. I'll also share some of the experiences in terms of representations that we have had with the regulators, including the regulator in IFSCA as well as the Government of India. This, I know there has been a lot of focus after the good presentation Shreyash Bhai gave in terms of AIFs. But GIFT City is not only about AIFs, but it is about a larger ecosystem of financial services and financial products. Let's try to understand what is this from the lens of the products, from the lens of the taxation, and lastly but not the most important, what is the rationale in terms of why these structures are being developed. So I know this section has been covered. I'll just take a couple of minutes in terms of mentioning a couple of things which came up in the questions. That this zone is a financial services zone because it's called International Financial Services Center. And it is benchmarked to global financial services centers which were developed like hundreds of years back, be it in New York, London, Hong Kong, Singapore, and DIFC being recent one, Labuan. So all of these, the way they operate as financial service centers, they develop this zone with an objective to do certain activities of financial services, and they give certain additional leeways and benefits for this ecosystem to be thrived, right? And unlike a manufacturing unit which will require huge land parcels, a financial services typically does not require huge land parcel. It is more in terms of vertical billings, but it is the volume of transaction, money flow, which is the more important one. This entire thing got conceptualized in 2015. In fact, there was a 2009 Percy committee report. I don't know many people know about that, but it got conceptualized in Gift City in 2015. Till 2019-20, there was not much traction, right? And Shiraz Bhai mentioned also, right, that there were erstwhile SEBI regulations which were governing the AIFs. Similarly, RBI was governing the entire lending and banking part. IRDAI was regulating the insurance part of it, which was making this zone very complicated for a simple reason that there was no particular financial services regulator which was regulating this zone. And one of the recommendations which went to the government of India is that we should have a unified regulator, and that is where the birth of IFSC came in, and which was covered in the first session. Now, the regulator sits in that zone, their KPIs is this zone, and therefore they focus per se on this zone for the development. And they do roadshows across India and across the globe to develop this zone. In fact, they have been, many people do not understand, appreciate, but they are really sister regulators to RBI, IRDA, etc., reporting directly to the Ministry of Finance. So their power is such strong. It is a matter of time when this zone starts developing and the regulator also starts growing in the stature per se. And whatever has been our experience has been that this zone is not largely about tax. Okay, tax incentives are being done with an objective to give parity to global taxation in a number of scenarios. From an India perspective, we will think that, oh, there is a 10 years tax holiday, because this is one thing which everybody understands, right? Everybody has heard, and every article will cover this part of this. But this tax holiday has a rationale in terms of why, how, what is the reason, how it being globally benchmarked. For example, if you are a chartered accountant in India, you will feel that across India, there is no place which gives you tax holiday. But Gift City is the only place. But people who are coming in Gift City are being attracted from global centers, because the motto is to onshore things which are offshore. If they are going to Singapore, for example, or Dubai, for example, Dubai is a better example, there is a tax holiday of 50 years. Gift City gives a 10 years. Now, if we just think as a professional who is advising a client on a structure basis, and you are asked to give an advice, an opinion, what is more beneficial? Is it 10 years tax holiday or 50 years tax holiday, which is more attractive? Right? So, yes, there is one set of feelings that people have that, oh, there is a 10 years tax holiday, but there is also corresponding global environment in which we are competing. And that is the reason why a lot of these amendments that we regularly see are required. And the reason why I see so many amendments, because this zone is in a nascent stage of development. As things develop more and more, we'll have more changes which get established. So that's the whole idea of this Gift City zone. It is a financial services zone, so only financial services activities will get permitted. Funds is well covered. The other ones are banks, insurance, capital markets, listing, treasury, aircraft leasing, ship leasing, and interestingly, the government of India has also realized that there are certain parts of non-financial services companies, say a pharma company, airline company, etc. They also have a segment of financial services in their activities, which, by the way, is very, very large, which is also in the more common parlance called as corporate treasury centers. That is being done. Then there are foreign universities which are coming on the shore. And there are strong reasons and rationales about it. And I'll cover that along with the taxation, so that you have a slightly broader vision in terms of why this tax is required and why these amendments in the law were required. So tax, or if you look at slightly broader, is fiscal incentive, that as it is called. It has 4 limbs broadly. First is the income tax, and largely my focus is going to be around the income tax and the structure around it. Second is the state incentive. Now, this state incentive is very beneficial for anybody who is setting up a unit of more than 50 people. The reason and rationale for it is simple, that they want to generate employment, attract employment. This is equivalent to a lot of PMLI schemes which are given by states for manufacturing units in the tier 2 cities and beyond to attract new industries coming in. We have one of the most common is the semiconductor industry that we hear a lot of states fighting on. Then comes the customs and GST. Is this, again, there are certain benefits, largely not much benefit, but how the zone approaches, that has impact. The only thing which is beneficial is because it's a multi-services SEZ, any goods that you take into that zone, there is no custom duty which gets attracted, which is the large part of it. Corporate law, most of them are simplifications in the procedure. The most important thing is the 5 years tax holiday. 5 years CSR holiday, which has been granted by the central government. Now, these are 4 pillars, but all of them stand on one very fundamental thing, which is a small notification or circular way back in 2015, which was issued by the Reserve Bank of India, which basically said that this zone is a place outside of India. Now, place outside of India means what? Means that you visualize this zone to be in Singapore, Mauritius, somewhere, from a FEMA perspective. I'm underlining the word FEMA for the simple reason because it's from an Indian exchange control perspective, because in India, as chartered accountants and regulatory advisors, we always have limitations or restrictions in terms of how you deal with non-residents, right? But when you are in that zone, there is no capital account convertibility limitations. Capital is fully convertible. The transactions are in US dollar, which actually is the biggest benefit of this zone. And all the structures that get developed are based on this. Tax holiday is just cherry on the cake to attract or to incentivize for people to move forward. And there is a strong reason for incentivizing this, is largely because of the fact that there are many structures which are already established in some countries. Now, in order to move them to the Indian shores, you need to incentivize them. Like I gave an example of 50 years tax holiday in Dubai versus a 10 years tax holiday in India, right? So those are the reasons or rationale, and this capital account convertibility of FEMA relaxation of 2015 has been the biggest benefit. What it means is very simply, you are in Singapore. If you are doing transactions with anybody in the world, no capital restrictions, no FEMA applies. But the moment you start doing transactions with India, you are like a Singapore entity, right? So for example, if you are going to put equity as 20% stake in a company, you have foreign direct investments. Till now, what we are used to is the fact that we will be receiving the money. That set of compliances or that set of perspectives we are looking at from a business perspective. Now the scale is completely reversed. You are now looking at inwards in terms of what are the consequences if a Singapore or now a gift entity is going to put the money in India. So all of these things are there. But having laid down the foundation of what is the core benefit of the gift city, we come to the direct tax incentives. There are many, and what I'll do is, rather than taking you the text of these, what I have done is try to put across models in terms of use cases, wherein all of these will get bundled up, and you will see the benefit on a holistic basis. 3 or 4 I just want to just mention, which are critical. First, there is a 10 years tax holiday out of a block of 15 years, which I think everybody is aware. I don't need to dwell into that much. Any payment made to a non-resident in the form of interest by a unit in IFSC or deposit is subject to a perpetual exemption. The logic is very simple, that if this money was kept by a non-resident in a Singapore bank account, India would never had the right to tax. And therefore, this is a perpetual exemption. You may think of a perpetual exemption, but this is a rationale. Similarly, on the fund side, when non-resident comes in a category 3 fund, which is making the payment, which again I'll cover in detail, there is also perpetual exemption for the investors because the fund is paying the taxes. That's the objective. And then there are certain other benefits from an aircraft leasing, ship leasing perspective, which is all makes important. Now, one thing to note, because this is where, as we get into this subject deeper, is where people start getting confused, is we have always heard or thought about entities which are resident in India from FEMA as well as income tax perspective. Vis-a-vis non-resident for both FEMA as well as for income tax. But here things are different. While 2015, it has been considered as place outside of India, but from the perspective of income tax, it is a tax resident of India. So it is a hybrid structure. And because it is hybrid structure, it means that it becomes a global income taxable in that structure, point number one. And therefore, every time you create a structure, there are arguments which come into picture in terms of relaxations that will require for the structures to work. And that is where there is a lot of to and fro which happens. For some reason, the government of India and the CBDT is not in support of notifying this zone as a non-resident from a income tax perspective too. Because this goes to our fundamentals of CA Foundation, right? If you are a resident, global income taxable, but if you are non-resident, only India source income taxable. That's the fundamental difference which starts triggering over here. Now, having laid down this very clearly, what I will do is get into some of the models on the gift city side of it. This entire diagram on the left-hand side, let's focus on the left-hand side, and text is what I'll cover in the explanation. There are 4 or 5 elements, right? First is your fund management entity, which is the investment manager, which is the brainchild who runs this entire thing. Second is the fund, which is the center where the money gets pooled. There are foreign investors, the yellow box, and then where the money is being invested, right? This is the thing. Now, first is how do you set up the fund management entity? The fund management entity can be set up by Indian residents, or Indian companies, or Indian promoters, or by non-resident. Both these are allowed. Indians, if they put that money, that is considered overseas investments, because this zone is outside of India. As I told, logically, you are moving the cash out. So you have to adhere to 400% of your net worth. From an income tax perspective, for a resident, whether a company or an individual, there is no tax benefit. So their income is taxable, as simple as that. So the only benefit for them is they are able to do something in this zone, which they are otherwise not able to do this. So that becomes the most important part of why to set up in gift city. The fund management entity, which gets the investment management fees, enjoys a 10 years tax holiday. When the fund management entity is going to give dividend out to its non-resident shareholder, the withholding tax under domestic law, which is typically 20%, goes down to 10%. That is one relaxation which has been granted. But again, that will be subject to treaty protections, if any, further. Most of the treaties that we have seen is largely the difference of surcharge and cess, which is 1% difference, because the rate has already been benchmarked. Now comes the foreign investor. When the foreign investor is putting in money, no problems. There will be surely FATCA and CRS filings, because it is India's obligation to the world to make those reporting. So that continues, no relaxation, because many people conceptually do come and ask that, "Arey bhai, ye zone is outside of India, does FATCA CRS apply?" So those reporting obligations are there. FIU obligations, which Reyes bhai covered in detail, are all there as a part of the work. Then comes the gift fund, right? Now, the gift fund, what they have done is, it is the benefits are brought into the Income Tax Act under Section 10(4)(d) of the Act, which basically says that when the securities are invested in the Indian capital markets, the equity capital gains, short-term or long-term, is taxable, which is there for most of the treaties, except for, I think, France, Denmark, and few others. And debt or derivative is exempt, and it's a perpetual exemption. Then comes the next question: interest and dividend, which is passive income, is also perpetually exempt. Is subject to a lower rate of 10%. Again, benchmark to global best practices. I think UAE and a couple of countries have a lower rate. That too only for banking companies at the rate of 5%. Otherwise, it's benchmark. In fact, it's better than Singapore by 5%. That's broad benchmarking on this. If their investments are made in global securities, the income as well as capital gains, passive as well as active income, is exempt perpetually. The logic of this is simple, that if this fund was in Singapore, again, India would never had the taxing right. So how will you tax that? Because if you see in this structure, the money is all coming from non-resident only. It is not coming from India. And therefore, they are saying, if this fund, because typically what would have happened is, a global fund would never set up in India. It would typically be an India dedicated fund, or fund which comes into India, which is being set up. So that is the benefit which is being granted. If you're doing on IFSC securities, again, it's not taxable because similarly, non-residents, when they directly invest on gift securities, which is largely derivatives, is exempt. The derivative security being SGX Nifty on the gift exchanges. So that's the benefit that has been done. Investor, when they get a return or they exit, there is no capital gains or tax liability because the tax liability is being borne by the category 3 fund per se, conceptually. And therefore, this becomes your entire scheme of things that the investor, from an investor perspective, no taxation requirement, no return filing, no PAN requirement, only FATCA CRS reportings happen. When it comes to fund, they need to do regular compliances, which is filing return of income and stuff. The fund management entity will file the returns, etc. That they need to do. Plus tax holiday, they are claiming because income tax will not naturally ask you to fill up some forms, that is need to be done. One interesting question which came up, I'll come to you, was in terms of payments of royalty, right, which is paid by the FME, not by the fund, but the FME to non-resident investors or domestic service providers. Is there no withholding on that because it's zone outside of India? The answer to that is no, for the simple reason because there is no exemption provided. It is payment by an Indian company to a non-resident, which I think all of us are used to. So there is a 15 CACB that typically, and the withholding, make available, treaty protection documentation will be required. One thing to add to the entire thing is whenever the payments are exempt, like for the investor in this example or interest, then the argument was that why should you do the entire 15 CACB because it only slows down the process, correct? And therefore they did away with the 15 CACB requirement and that was replaced by Form 15 CD to be filed by the remitter on a quarterly basis so that the income tax department has the information about what transactions are there. That's the logic. I'm just going to pause here. Yes, you had some question. Correct. Yeah. Thank you for asking the question. Very interesting question. Uh, so the debate has been, unfortunately, okay, let me take one step behind. As CAs, we always have a problem that the understanding of the regime is clear, but the language is not clear. Here we have a completely reverse scenario where the language is too clear in the law, but the intent is not very clear because when during the COVID period, the section 10(4)(d) was introduced, there is no memorandum to section 10(4)(d) which provides the logic for this. Now, there has been a lot of discussion that can I take 10(4)(d), which basically means for other than equity, everything is exempt. And for the equity, I claim a section 80LA. 80LA is, by the way, not an exemption, it's a deduction section. Okay, it falls under chapter 6A. So you do your computation, reach a number and get a deduction. Now, what people have been trying to achieve is basically saying that in a fund structure, in addition to all those things, we also want to claim a tax holiday, which is 80LA. So basically for 10 years, everything is exempt, right? Which becomes much more attractive to us. But we have had a lot of discussions on this, but we have not been comfortable on this per se, because ability of the fund, being a trust typically as a structure, may be limited in terms of claiming the benefit of being a unit in SEZ, and also the fact that this has not been the intent of the regulator, including the IFSC and the income tax, when they brought in this. So the answer to that is, A, many people want to do that. B, it is a highly aggressive position if somebody wants to do that. And C, I have not seen anybody doing this. Only discussions are happening. This is getting discussed a number of times as we go into structures. We'll touch upon on outbound structures where there is no specific regime, but I'll touch upon that where we reach there. So that's the benefit in terms of Gift City fund from a tax perspective. This is not for every fund in Gift City. I should have told it earlier. It is largely for category 3 funds in Gift City, which basically are so-called diverse or complex strategies, which are active fund strategies, not for the private equity kind of transactions or structures per se. Because there has been, and typically what will fall into this is people who are wanting to do listed securities, derivatives, debt, actively trading on the gift, arbitrage funds, etc. These are the categories of funds which will fall in this. What we'll, yes, yes, correct. So that scenario, sir, will happen in case of an outbound fund. It's not kind of inbound. This is an inbound fund structure. For an outbound fund structure, you are right, because the fund is in India. From an income tax perspective, also domestic or resident, payment is being received by another resident in India, and therefore what is being done is a transaction within India. So you will fall not in the bracket of section 195 of that, but on the bracket of section 192 to before 195 of that. So no 15 CACB required. Um, this is a very high-level synopsis of the benefits of Gift City from a taxation perspective, which basically says that, as I said, equity is at par with Singapore and Mauritius. Um, Capital gains on derivatives and debt is exempt under those treaties and in Gift also. But Gift is green and those are blue for a reason, that all the treaty accesses for the funds is subject to treaty eligibility, TRC, substance requirement, MLI requirement, and which includes the PPT test, principal purpose test. All of these do not apply to Gift except the Indian General Anti-Avoidance rules, because this entire code of taxation is hard-coded in the provisions of the Income Tax Act. And therefore the threshold from a software perspective or substance perspective is lesser or expectedly lesser than the gift fund. Naturally, the objective is therefore not to just create post-box entities in Gift City. The regulator will be very clear in terms of the substance requirement, people, how the activities are being done. And this is where maximum amount of debate happens with the regulator in terms of people, activities, decision-making flowcharts, governance models, etc., across structures per se. That's the important thing. So this is a snapshot, the last item, which is not regulatory more. Operating cost Gift City is naturally cheaper than any of the international zones. One thing to mention is there is also been asked that on a personal income tax front, a relief should be granted for people working in Gift, but that's something which is not that the government is wanting to entertain. So everybody who works in Gift City is subject to, like any other individual taxation that you and I are suffering. This now dips into some of the use cases in terms of the category 3 funds and how this entire thing is getting developed. First is foreign funds have an category 3 fund in Gift City only for investing in mutual funds in India. Now, mutual, as you know, under section 1023, the mutual funds are exempt. Any income they distribute is exempt. The gift funds income gets exempt and the non-resident is exempt. So it becomes a good via media structure for somebody to set up a gift fund dedicated for pooling structure in Gift City for mutual funds. This is largely being used by a lot of Indian mutual funds to create their pooling structure in Gift City, such that money gets pooled into the gift structure or feeders into India. The benefit is that the compliance obligations are lower, the tax rate is better, and rather than going for these funds to go to Mauritius and Singapore to create pooling structures or have direct investors coming in the fund, it is lower. So that's the big one. The second is the NRI only fund, which for accessing in India, because this is a zone outside of India, you are subject to foreign portfolio investor outright. Now, this is something which, and in that foreign portfolio investor route, maximum amount that is allowed from a non-resident is on an aggregate basis 50% of the corpus of the fund. For Gift City, they have made it to 100%, which means that only place in the world where you can do inbound fund with a NRI family or NRI people being 100% contributors of the fund is Gift City, nowhere else. And therefore, this starts becoming attractive to multi-family offices globally, which are NRIs, OCIs, PIOs kind of thing, to pool in Gift City and invest in India. So it's something which the wealth managers are very interested. The left-hand side structure is on the debt securities again. Debt securities into India gives you a better rate of 10% vis-a-vis 15% in the Singapore treaty, and the exempt the positions are exempt. Right-hand side again is the promissory notes structure. Promissory notes are basically OTC derivatives based access to Indian capital markets, wherein the investors do not want to directly take licenses in India, but you want to use or leverage on licenses from somebody else. So those structures is something which becomes attractive for people to invest in India. Now comes the outbound fund, and the outbound fund is very, very different than what we spoke about. The outbound fund is actually Indian residents wanting to put money outside of India with the logic to diversify their risk, put in the global securities, the most famous being the FANG ones, which is Facebook, Apple, Google, and Netflix as the security, where people want to invest. And if you look at the LRS data from the Reserve Bank of India, investment in global securities happens to be the top 3 items on a monthly basis. So that's the amount of money which goes out of India. Indians are only allowed to put in $250,000 per individual per annum. For many, this is a very less limit because people want to take higher amounts out of India, which is where I realized that India is a very rich country. It is not a poor country, but nevertheless, these are structures which are coming up in GIFT City where individuals, while they had the ability and capability to invest, they did not have the skills or asset management capabilities to do that, and therefore it is a mutual fund equivalent structure for investing globally. One thing to note is Indian mutual funds could also have done this part of this because that is the natural questions which comes to us, but there is a limit that on India basis, the maximum that Indian mutual fund can invest overseas is $7 billion across mutual funds, which will interest you is that limit has got exhausted. That is the money which has gone out, and therefore that route is no longer available to most of the mutual funds. And therefore this is an alternative route where the mutual funds do the pooling in GIFT City using individual limits of people of $250,000, and that money then goes out. And also there is something called 50% OPI, which is available to non-individuals, which is also permitted for only funds in GIFT City. So that's another route in which the money will go, because a lot of large families will have their structure in the form of a company, which will, or LLP, which will allow them to move money outside of India. Again, there is no taxation benefit on this. There is, because there is no benefit from resident. And this is where that question comes in, can they claim ATLA on this? Because they will set up this structure in a fashion that, because there is no 1040 benefit, which is largely on account of fact that the money is all inbound funds, they are looking at claiming a 10 years tax holiday on this. Again, a very aggressive structure when you especially set it up in the form of a trust, because trust at times may not be eligible for this entire unit benefit in GIFT City. Then next is again, I'm explaining the structure as well as the tax benefit which is there, is on the portfolio management services. So if you are a portfolio manager in GIFT, where the wealth advisor, taking money from non-resident and putting the money outside of India, that is also not subject to tax in India at all. It is exempt. After the SVB, Silicon Valley Bank crisis, the GIFT banks also tried to open bank account of foreign entities in India, and they were successful to some extent. Those accounts, again, there is some benefits for them. Again, that's a very small use case. I will not cover that much. Now comes the other part of the fund, which is more strategic funds, which is the venture capital funds, private equity funds, etc., which do not fall in the category 3 or diverse and complex and diverse strategies, where there is no benefit per se which is being granted. But what was happening at the ground level was basically a lot of Indian fund managers wanted to set up their pooling structures in Singapore and Mauritius. Mauritius was preferred more for a simple reason that the cost of operations were lesser. But what was happening in real times was there was always a PE or POEM risk, which we understand, place of effective management risk on these structures, because the head and brains and the people who were taking decisions were sitting in India. And they found it very onerous to travel every time for decision making to a country like Mauritius or Singapore. There were visa problems, time not being available. And that is where this entire ecosystem coming to Gift City makes it very, very attractive for them to set up in Gift City, pool the structures from non-residents, and then invest in India markets. The entire risk on the structure, which is a PE or a poem risk, goes away, because from an India perspective, this fund is an Indian fund, right? And you cannot have an Indian fund having a P or a poem exposure, because it is a poem in the first place. Please, with the benefits of benefits that they get in Mauritius, Singapore. So that is where this entire thing became attractive. And just to sweeten the deal, the government said that the investor would not be subject to file any returns or obtain a PAN, but the fund will be obligated to do withholding, and they have to see qua each investor what is the respective treaty or protection, and accordingly do the withholding. So whenever there is an exit, the fund will get the full money. It will be obligation of fund to withhold the taxes according to the investor's taxation position. So that again, from an operational perspective, becomes attractive, though it's not very, very beneficial. Some of the funds are also looking at moving part of the activities to Gift City, such that investment management fees is split between Gift and in India, which brings them benefit from twofold. One, the fund management entity gets a 10 years tax holiday, plus there is no GST on the fund management fees which the FME in Gift earns. So from an economics perspective, this starts making a lot of sense from them, because overall their returns or their income per se goes up in this structure. Last, from a fund perspective, is the relocation of the funds, because the government realized that while they have started this journey in 2020, there has been a lot of history in the past, and there are a lot of India dedicated funds already outside of India which are investing in India. And if these funds wants to move to India or in Gift City, they will require some tax neutral positions, because if think of it, if the Mauritius funds wants to with $1 billion position wants to transfer to Gift City, and there is a tax liability immediately, it impacts the NAV of the funds, right? And therefore they brought in the tax neutral position under the income tax law, which basically says that if you are moving from country A to Gift City, you have to set up a new fund. You transfer all your assets from fund A to the Gift City fund. There is no exit from any of the investors. All the investors continue. Or you can have your fund also continue as an investor in the new resultant fund in Gift City. There will be tax neutrality on the structure. This tax neutrality is important because this provides them continuity of the period of holding and other treaty protections, etc., which then helps the Gift City ecosystem to grow faster, because people don't say that only when I set up a new greenfield fund that I will set up in Gift City. The plan is that they will set up or start moving the fund faster to the Gift City. And there are around 15 to 20 funds which have globally moved into the Gift City, largely from Mauritius and Singapore. Yes. So 9A for Gift City is not required, because the fund management entity as well as the fund both are in Gift City. But if you are setting up in Gift City and as a FME and doing global funds management, which creates a PE poem exposure, then a 9A approval still continues to apply in Gift City. Thank you. I'm just going to shift gears to non-fund structures, because this is also a very strong ecosystem for financial services that is set up, which is the banks. From a bank's perspective, when they are lending, or when they used to do ECB lending, which is again a big form of lending to Indian corporates, or government of India for that matter, there was subject to withholding. Now that withholding was typically in the range of 10 to 15%. Again, UAE being the lowest at the 5%. If I throw some numbers at you or give some numbers to you, is that 5%, the rule of the game was, because the lender always has the upper hand, they used to pass on the tax cost on the borrowers in India as Indian corporates, which in our technical term is called as grossing up of the taxes. With a 5%, which is the lowest possible rate, the grossing up rate was around 5.8%. 10% went to 11.11%, and at 15% went to 17%. On 30th June 24, the government had a scheme of 194 LC at 5%, which they withdrew. So naturally, the entire withholding rate went up from 5% to 20%, which the gross up became the 27.94%, which in in a business term means an additional interest anywhere between 75 to 150 basis points additional interest cost on the borrowers being large corporates in India, which made it very cumbersome for them. So therefore, the gift city ecosystem came in, wherein the banks have 10 years tax holiday, and there is 0% withholding. So in the whole story, what happens is the additional 11, 27, whatever that number will be based on your cases. And the reason I gave you numbers was largely because different banks come from different countries, right? And therefore that number will drop down substantially. So that is the benefit which people are interested in today. In the last 4 years, the banking ecosystem in GIFT City has an asset size of $80 billion. That's the amount which is being lent out of there with a very strong rationale. And what we are seeing is that people now, banks have started becoming more aggressive, more confident about this, and they want to do even non-India lending from GIFT. They want to do additional products. NDF is another large product which they have in the GIFT City, promissory notes. So and therefore what is happening is the entire basket of banking services, which was quote unquote foreign banking services, is being moved to the GIFT City zone, which is starting to become attractive. Last but not the least is there is something called as BEPS Pillar 2.0, base erosion profit sharing, which basically says in every country as a group you need to pay minimum tax of 15%. Surely applies to very large organizations like banks, etc. Because they have India presence in the form of banking, which pays around 42%, or now 38% after the last amendment. When they blend it out with the 10 years tax holiday that they get in GIFT City, they are still above the 15% threshold from an India franchise perspective, which actually makes a lot of sense for them to save on that taxes, which is making this entire thing very attractive for foreign banks to set up. Insurance companies, again, you'll note that what I'm speaking of is all about financial services. So India outbound for insurance companies, life insurance companies, because life insurance companies which take policies where we are the customers cannot invest outside of India. And there is a very limited window of exemption, right? So which they can take from GIFT City. They can sell dollar denominated products and invest in dollar securities, which gives them exemption. In fact, for the investors also, there is a huge and perpetual exemption if they are non-resident. The thing that they are trying to attract the investors in GCC and other countries where Indian population is situated is that they get perpetual exemption, and especially when they come back to India after their retirement age. So that is one. Reinsurance is of foreign reinsurance companies doing business with Indian companies. Again, very nuanced. There is a better order of preference and lesser collateral requirement, which reduces the cost of doing operations in GIFT City or doing cost of business in India. During the break, Kinjalbhai, I spoke with you on the capital markets piece. There are 3 benefits. First is Indian corporates, if they are giving to a non-resident, the withholding tax is 20%, but they simply list on the GIFT exchange and there is non-resident investor, the withholding on interest goes down to 9%, right, which is a good 11% saving. And to that extent, a lot of corporates like Shriram Finance, Adani, state units, all of them have set up or listed on the GIFT exchange. They don't need to set up over there, but be a part of the GIFT City ecosystem on the listing part of it. Then is the proprietary trading, where a lot of people are setting up in GIFT City because the brokers in India are not allowed to do proprietary trade in global exchanges out of India, which they are now allowed to do out of GIFT. There again, they get a 10 years tax holiday. Now we are seeing the 10 years tax holiday is getting replicated across different structures. And last but not the least is ability to do global investments out of the GIFT City zone. Finance company, and this is one very unique case where and I think it touches everybody's life in India, right? Where our family members and kids go abroad for studying, and there is a loan that they take. Typically, you end up taking loans from Indian banks or NBFCs. Now, one of those NBFCs is set up in Gift City, and they want to give dollar loans because the investment is also in dollar, or the education loan is also in dollar. So therefore, naturally, it starts making it more attractive. Also, they get a 10 years tax holiday, so they can pass on some of the economics as a part of the loan period to the students who are going abroad. And the best thing is they don't need to incur the cost of hedging, which is also a big part of the cost of doing business, which is taken care of from a Gift City perspective. I think this is another big thing, and this is for the non-financial services, wherein there is a set of large number of Indian corporates, just to name like Indian Oil, BPCL, all of that. They have a lot of international subsidiaries, wherein there is a lot of transaction, cash pooling happens. Holding of these companies are required. You need to give debt. You cannot do it every time from the Indian parent, for the simple reason that every time you do it from Indian parent, you are subject to ODI regulations, point one. And second, the most important is you are subject to exchange risk, foreign exchange risk. For example, if your company A and company B in outside of India, you want to move the dividend, you need to get it to India, one exchange currency difference. You move to company B, again there is exchange difference. And on all of this, you will end up paying taxes, right? Because you are getting money into India in the form of income. You create a blocker in between in Gift City. There is no taxation, and all your transactions are covered from a foreign currency risk perspective. This can be done differently for Indian corporates, which are Indian headquartered companies. It can also be done for foreign headquartered groups. I don't know, most of the foreign headquartered group directly don't come in India. They largely have been using Singapore or Mauritius as their holding company base or blockers. That blockers can move to Gift City going forward, such that this entire currency risk is taken care. Some of them are, this concept is called as a global treasury center concept, or more common parlance, in-house banking concept, in-house bank, where a lot of hedging naturally is done out of this structure, because between a receivable or payable, you can just net it off at your level, which in India for an export you are not allowed to do. But if the same export receivables for some reason can be moved to Gift City as a financial services, you could potentially net it off. And anybody who is having global trades, global activities, whether Indian headquartered or foreign headquartered, this becomes attractive. A lot of multinational groups are also trying to, or looking at Gift City because of the BEPS Pillar 2.0 benefit of no global minimum tax being attracted on this structure. Ship leasing and aircraft leasing is similar. I'll just take this aircraft leasing model and just explain it to you. Sorry, I'm just mindful of the time. Do we have 10 minutes? Yeah? Yeah, thank you. So for an aircraft leasing, typically Dublin was the hub for aircraft being leased. Leasing can be divided into two parts, as finance lease and operating lease. All of us understand the difference between the finance lease and operating lease. Because this zone is a financial services zone, naturally finance lease was permitted. But what they realized in the whole scheme of things is that the level of confidence on finance lease will take some time. And therefore what they have permitted is an operating lease as a nominated financial services activity. Which basically means there will maybe back-to-back planes being leased in the initial years and given to Indian Airlines companies. Now the benefit was that the lessor who was previously in Dublin, they used to get a lot of notices from Government of India that do they have the substance, have they rightly claimed the treaty protection. Because the lessors in Dublin never used to have their own money, they used to raise the money from global lenders who were not in Dublin. So naturally it was the question of beneficial ownership, pass-through status, substance, etc., which was questioned by the tax office. When they do these structures in the Gift City, this becomes much more attractive from withholding perspective and gives much more clarity in terms of taxation, and much more certainty. Because certainty also comes, or uncertainty comes with the price of taking an insurance, which becomes a large cost of the cost of investments. So There have been different models where there are back-to-back models on SPV structures, etc. In GIFT City, which also the the government of India has given exemption. That can be divided into a 10 years tax holiday, plus any form of dividend or interest, any form of royalty or interest paid by a gift unit to the lessee outside of India is also permanently exempt or perpetually exempt. So that's the modeling, because from a reader's perspective, it will feel there is a perpetual exemption, but sorry, but from a business perspective, which was already incurring or getting these exemptions, taking away then exemptions and retracting them to Indian shore will never make economic sense, right? It will take away the entire economic sense, which they are then able to get it into the gift city zone by giving them more certainty. And that is the reason in terms of the logic. This applies equally for a ship leasing kind of thing. There are some differences in terms of the operation regulations, in terms of Shipping Act and all those things which apply. I'll not get into the nuances of that. I think this is the second last thing which I just want to cover is, and we touched upon this in the beginning an hour back on the BATF, which is for chartered accountants. You can set up your bookkeeping, accounting, taxation services work for any of your global clients out of GIFT City. Naturally, there are a couple of benefits. 10 years tax holiday is there. Second, you are not required to convert your earnings into INR, which is what will be mandated over here. Third and most important is you are not suffering a risk of foreign currency depreciation, because the money continues to be in dollar terms. That's the real benefit in terms of why people with large exposure or large clientele on bookkeeping, accounting are operating out of or wanting to operate out of GIFT City. Second is the TechFin companies. TechFin companies are largely Infosys, Wipros, etc. Where what they have realized is that any set of technology services, because this is a financial services zone, being Infosys, you're not a financial service company, right? But you can render services to your BFSI, which is banking and financial services clients out of the GIFT City, which naturally brings them to a lot of benefit, because their contracts, while they be large, are highly competitive from a price perspective, and the 10 years tax holiday makes it very, very attractive for them to do those activities. Last, this is the most left-hand side structure, is the GCCs. Yeah, India is a flourishing bed of GCCs, largely because of the talent, English-speaking population, which is there across India. In addition to that, you can set it up in GIFT City also. The benefit of that is 10 years tax holiday, which makes the life cheaper, or sorry, the labor arbitrage is further higher because of the tax holiday. But for all of these activities, you will realize that none of these activities are ones which will require 5-7 people. This will require more than 50, 100 people, 500 people, and that is where the focus of the government is, that we want more employment and actual headcounts of the GIFT City, which is also what brings to the next point is they have also introduced therefore the state incentives, as it's called. I'm just going to give you a snapshot of that in terms of the numbers. There is two types of benefits. One is OPEX benefit and CAPEX. OPEX is your running costs, and CAPEX is in terms of capital expenses. Broadly, from a numbers perspective, it will depend on how big unit you are being setting up. Surely, the larger you set up, the more money comes in. So if you are setting up a mega project, which is the bottom one, the CAPEX support is 200 crores Indian rupees over a period of 5 years, and OPEX is 40 crores per annum, with a cap of 15% on that expenses. There are detailed rules in terms of what is happening. This surely goes down for non-mega units, where the investment is less than 250 crores, to a reimbursement cap of 50 crores, which is almost 1/4 of for CAPEX, and around 50% that of for the OPEX. So you'll realize in the whole scheme of things, this becomes a basket for a GCC, and the reason why people come to GCC or Infosys, etc., has been largely on account of labor arbitrage or cost arbitrages. Now, these cost arbitrages can be further enhanced through the fact that there is tax holiday, you don't have to face a currency risk, lower dividend tax rates, and last but not important is the state incentive which the state government of Gujarat provides, and only for the IFSC zone and the gift city zone in the DTA. So that's largely and broadly an overview of gift. Again, as I mentioned, what I tried to do or cover is taxation added up with the business part of it, so that there is a broader understanding. And last thing I just want to share as an experience in Gift City, that what people have tried to do or build structures in Gift City has been around tax holiday, 10 years tax exemption, but that is where most of the structure starts failing. It is largely in terms of a tax or regulatory arbitrage that makes it attractive a business model, because in simple terms, and one of the client told me is, Jugal, if you may give me the best tax holiday in the world, but if it does not make a business sense for me, why should I come to the gift city zone? It is as simple as that at the ground level, and therefore the government is constantly working in terms of identifying the issues, and they are in touch with the industry players to get their feedback on that. Yeah, thank you. Happy to take questions.
Thank you, CA Jugal ji. Any questions for sir?
Jugal, good afternoon. Thank you very much for a nice session. The same question that I asked before the break. There was a slide, second or third last slide in your presentation about aircraft and ship leasing, the financial aspect thereof. Can that be tweaked for a similar thing for high cost medical diagnostic equipment globally? Yes or no?
Yeah, hello. Yeah. So aircraft and ship leasing was the first thing which came in Gift City, and there is a strong logic for that being permitted. Like operating lease on aircraft and ship was permitted because that market did not exist in India. The next one, if somebody, I'm sure you would not have tracked, but there is something on oil industry equipment leasing, which is a very nuanced thing that is also going to get enabled in Gift City, okay, as an operating lease. The logic of that has been that this market is outside of India, not in India. But if you are going to do a pharma leasing or medical equipment leasing, which may be costly, I'm not saying not costly, but is there lending market in India? Are there lenders or bankers in India? If not, then we'll have to go to the regulator with strong reasons and rationales before they consider this.
Thank you.
No. So AIF3 giving it to the clients is perpetually exempt because the AIF3 does it. But if the fund management entity, which is the investment manager, is giving it to the clients, to their shareholders, that will be 10% withholding. Section 115A.
Hello. Yeah. So basically in GIFT there is also NSE and BSE exchanges. So there is a GIFT Nifty concept which came in. So so for non-residents, if they trade for GIFT Nifty also, is it exempt for them, and can resident players also invest in GIFT Nifty?
So non-residents can. It is exempt for them. It is a perpetual exemption. It is under Section 47 of the Income Tax Act. When it comes to resident, the security which is allowed is only right now, which is trading, as you said, is Nifty, which was in the past SGX Nifty, now it is Gift Nifty, and which we also all refer to in the morning when we look at the market, right? A lot of traders in here. So, but unfortunately for resident Indians, this is money going out of India under the LRS route, under a sub-route which is called as OPI, Overseas Portfolio Investments, where specifically derivative investment is restricted. And hence you cannot do derivative on the gift exchange. And therefore, if you cannot do, you cannot get a benefit out of that. That's the answer to that.
For outbound investments, is AIF under the GIFT or VCC in Singapore, which has a cutting edge?
Which has a?
Cutting edge, if you compare both.
Okay, so difficult one. The reason why VCC has a cutting edge today is that it is more established and it is more known to the people. Gift City structures for outbound are coming up. And to that extent, see, the investors, they don't understand these technical nuances like you and I do, right? So what their focus is, किसने किया है और कुछ प्रॉब्लम आया है कि नहीं, वही दो क्वेश्चन का आंसर चाहिए उन लोग को. So wherever they have use cases is where they'll go easily and faster. But Gift City use cases are coming up. On the outbound front, we have a lot of brokers which are moving to Gift City, like the Ind Money and likes. We have the DSP fund which has been launched, which is open to retail now, is being done. There is also arbitrage that you can put OPI money, which is 50% of net worth in gift. So overall, that basket becomes interesting. People have been trying to use the ODI route for putting money in the VCC in gift, but that is very customized discussion vis-a-vis your banker in terms of how they allow. So over a period of time, what the government will do is create strong use cases such that people have the confidence in gift for outbound fund structures also.
Thank you.
So, sir, they are under the IFSC Finance Company regulations, under which there is sub-regulation which is called as Treasury segment. They get registered as a part of that.
Jugal, I have one question. FMEs get 10 years tax holiday under ATLA. Now, is it only restricted to business income, or if it earns interest on FDs or capital gains when that gets deducted?
Is that the only one, or anything else you want to add to the basket?
No, that one.
Okay. So the answer to that is a complicated one, because if you read the language of ATLA, they have not said that the income which is exempt will be subject to tax under the profit and gains of business or profession. They have said that what is exempt for a 10 years tax holiday is approved business. So the movement or the argument which comes out is approved business is anything which is blessed by the regulator, FS regulator, which is IFSCA. If IFSCA in their regulations is allowing you to do that activities, you should be eligible for doing this. And I'm just taking this question further because if you're not asked, I'll mention that there are people who want to claim this benefit on this same logic for capital gains also, which is slightly and more aggressive view as of now. But FD and all those things should be subsumed within the whole thing. Sir, under which, as a bookkeeping accounting, right? As a part of, what is the nature of service? So sir, before you transfer that, the point is, can you do that same business out of Gift City? So if you're doing a PMS in India for foreign clients, for NRI, for example, for accessing the Indian markets, you still need to have SEBI registration. Therefore, you need to be in mainland. You cannot say, I move to Gift City and take a SEBI registration over there. That is not permissible because it is a place outside of India. Singapore entity cannot do PMS in India without having an onshore presence. So So you'll have to continue with this. But yes, if you want to do PMS in Gift City for NRI clients or same set of clients for gift investments or global investments, that should be permissible. You could move that part of the business.
Thank you, Jugal sir. May I request C. Nilesh Vasa to offer a well-deserved vote of thanks to Jugal ji.
Thank you, Manish bhai, for giving the pleasant task of this vote of thanks. Today, on our general overview on the topic of Gift City, Jugal sir has really explained about the taxation benefits in Gift City. So we are very much thankful, Jugal sir, for your nice presentation and giving the valuable time for our study circle. On behalf of Borivali Central CPE Study Circle, I propose a well-deserved vote of thanks with a big round of applause. Thank you very much. Anybody in the audience see a Rishabh Begani? Okay, thank you.